Hi folks, welcome to this video that reviews the concept of intercompany sales on depreciable fixed assets. And when we talk about depreciable assets, we're talking about things like machinery, building, equipment, those kinds of things. First thing you have to remember is that unlike inventory, when you have an intercompany sale of depreciable fixed assets, the consolidated entity is going to recognize any of that gain or loss in the consolidated books over the remaining useful life of that asset, even if it's not sold outside. So what we mean by that is that if the sub, say for example, decides to sell a piece of equipment to the parent and they sell it at an increased price, so that they earn some profit on the sale, let's say. The idea would be, most of the time, is that the parent would be using it in their business, and the intention wouldn't necessarily be to sell it outside. It would be to help them generate revenue within the business. So in that case, we would say, well, we should be recognizing that gain or loss in the consolidated books over the time that the asset remains within the consolidated entity, because we don't know if and when the parent would sell it outside. So there's no sense in holding that gain or loss or keep on eliminating it on assets that may never be sold outside. So that's kind of the logic we use. Now, how do we recognize that gain or loss? Well, the idea is that we would do it through an adjustment to the depreciation expense account, because related to fixed assets is this concept of depreciation expense. And in order to prove to you that it makes sense to recognize that gain or loss on the intercompany sale from a consolidated perspective by adjusting your balance for depreciation expense in the consolidated books, we're going to walk through a little example here. So let's assume that the sub buys equipment on July 1st, year one, for $1,500. They don't keep it. They immediately sell it for P for $1,800. Well, you can see here, if you bought it for $1,500 and selling it for $1,800, you're already recognizing a gain on the sale of $300 if you're the sub. If the asset has a remaining useful life of 1.5 years, we're going to have to take that $300 pre-tax gain into income over the next year and a half. The equipment is used by P, not sold outside. Both companies have a tax rate of 40%. These were the original statements in year one. So you can see that the parents booked a profit of $3,400, sub $1,700, and then we have their separate balance sheet accounts as well as retained earnings changes. So now let's have a look at how adjusting depreciation expense on the consolidated books would help us to recognize this $300 intercompany gain. Now, what would P do? When it buys the equipment from the sub, it debits equipment and credits cash separate entity. What does the sub do? Well, it sells it for $1,800, so it debits cash, it dumps the equipment, and it books the gain. So P has the asset now on its separate entity books. Over the next year and a half, it's going to depreciate $1,200 a year, or $600 for a half a year. And the reason I'm looking at the half a year is because, don't forget, in our question, it said that it was sold on July 1st, year one. So we know in year one, the parent would only book a half year's depreciation, which would have been $600. Now, if the sub had still had that and hadn't sold it to P, they would have been depreciating $1,500 on the equipment, assuming they wouldn't have sold it outside. They would have been depreciating $1,500 over the next year and a half, which is $1,000 a year, or in year one, $500. So you can see we have a $100 difference. So what does that $100 difference mean? Well, if P depreciated $600, and they would, because that's based on an $1,800 cost base, the sub would depreciate $500 if they had the asset and didn't sell it to P, again on a $1,500 depreciation base. That's a difference of $100. So all we're saying is that the true cost, or because the true cost to the consolidated entity of that piece of equipment was $1,500, not $1,800, the consolidated entity would say we should only be depreciating $500. So because the parent would be depreciating $600, we would need to reduce our depreciation expense by $100. So right away, when you decrease an expense, what's going to happen? Your income's going to go up, right? Because you're reducing an expense, your income would go up. So when income goes up, that's like booking, that has the same impact as booking a gain. So in year one, what we would do is we would reduce our depreciation expense by $100, and that would help us book $100 of the $300 gain into consolidated income. In year two, we've already gone through the numbers up here, and we've said annually they would be booking $1,200 a year, the parent. But from a consolidated perspective, because the true cost of the equipment to the consolidated entity is $1,500, we should really only booking $1,000 a year. But the parent would depreciate $1,200. So the consolidated entity would say, well, we're going to adjust that depreciation expense downward by $200 in year two. So you can see by reducing the depreciation expense $100 in year one and $200 in year two, over that remaining year and a half, we would have on a pre-tax basis booked that gain into income by reducing depreciation expense. So now we do a little calculation to find out how much of the after-tax profit would be recognized by the consolidated entity over the remaining year and a half, even though it's not sold to an outside third party. And you'll might recognize this to some extent, the intercompany profit analysis. That's something that we did in our inventory chapter when we looked at intercompany inventory profits. Remember, we had a before tax, tax, and after tax column, and this column in here is going to help us adjust our income or tell us how much we're adjusting income by. Well, at the date the sub made the sale to the parent of that piece of equipment, we do remember that the sub booked a $300 gain. That gain is going to be realized into income. Tax on that gain that would have been recognized through tax expense by the sub would be $120. So on an after-tax basis, their income has a $180 after-tax gain that can't be recognized fully in year one. How much of that $180 after-tax gain can be recognized? Well, the amount that's based on the reduction in depreciation expense. So we would be realizing through our adjustment of depreciation expense, $100 of that $300 gain, which is going to, when we realize a gain from a consolidation perspective, the consolidated entity would be increasing its tax expense by $40, which means on an after-tax basis into income, we would take $60 of that $180 into consolidated income. So that would mean that unrealized of that $180 gain would be $120, and we would take that into year two income from a consolidated perspective. And I think it's important that you realize here the sub has done nothing wrong. So in essence, they sold this piece of equipment to the parent, legitimately booked an after-tax gain of $180. So when we do these intercompany profit analysis pieces, we're not saying we're going to change what the sub did. We're just doing this to see how we need to adjust for the preparation of the consolidated statements. Okay, so now to facilitate the preparation of those consolidated statements, what I like to do with students is to help them see what the worksheet entries would be on the consolidation worksheet. And remember, the worksheet entries are not on P's or S's books. They're simply done by the consolidated entity. So what would we do on the worksheet, the consolidation worksheet, to facilitate the preparation of those consolidated statements? Well, one thing we said is that the sub booked a $300 gain, which not all can be recognized. So we would remove the gain and we would credit equipment for $300. The reason why we do this is because the gain cannot be booked by the sub on a consolidation basis. Separate entity, it's fine, but the consolidated entity can't show a gain of $300 on this. So what they would do is they would say, well, we're going to eliminate the gain, and the offsetting credit would be to the equipment, because don't forget, the true cost of the equipment to the consolidated entity is not $1,800, it's $1,500, the initial price paid by by us. So therefore, we would reduce the equipment. If we're going to remove the gain, we also have to reduce the tax expense at 40% of that gain. The consolidated entity says, well, The sub has paid that tax, so they look at it as prepaid tax, or what I'm calling here a deferred tax asset. My acronym is DIT, D-I-T, for Deferred Income Tax. So you might see that from time to time in some of the videos. I refer to it as DIT, which is Deferred Income Tax. So your text tells you to consider it like a prepaid tax. So again, when we eliminate the gain, which is up here in the consolidated books, we automatically would eliminate the tax expense on the consolidated books. We'd set that up recognizing that the separate entity sub has booked it as taxes that they paid, so the consolidated entity looks at that as a prepaid tax. So now, the net impact, when we eliminate the gain and eliminate the tax expense, the net impact is to reduce our income of the sub for consolidation purposes by the net amount, which is 180. So now, I've said here the impact in the consolidated net income calculation from A, look at the income statement accounts, debiting a gain or reducing the gain and removing the income tax effect has the impact of reducing income of the sub just for consolidation purposes. We're not physically going in there and adjusting the sub's income, but just for calculation purposes to make the consolidation figures right, we would be reducing it by $180. So I don't know if you can see this clearly or not, but we've removed the $180 gain after tax from the net income after tax of the sub. Now, you'll notice down here, it's kind of like we're removing the whole thing, and of that 180 we removed, how much of it can we recognize? So they deduct the whole gain after tax, and they only add back the after-tax portion that they can recognize this year. Granted, it's a little convoluted, but it's technically correct. Because of that 180 that we've removed here, 60 is realized. That $60 is what we calculated up here when we said, how much of that $300 gain pre-tax can we book? Well, in year one, we can book 100, and after tax, it's going to be 60. So basically, all we did is remove the 180 and add 60 of it back. Okay, so if you go down here in the calculation of consolidated net income, we'd have $49.80. Notice in this question there was no intercompany dividend, no other intercompany item where the P was selling to the sub, P was selling to S, so we make no adjustment to their separate entity net income. The attribution we talked about in chapter 5, or the previous chapter, so I'm not going to review that again. But just noting in non-controlling interest calculation, because the sub was the one who booked all the after-tax profit in year one, 180 on an after-tax basis, notice we're only derecognizing or unrealizing 120 of it. So the idea is, if they've gotten the 6,200 in their ending balance of year one retained earnings, the 6,200, that is going to include that 180 after tax, but we're only going to remove 120 because we said 60 here can be realized by the consolidated entity. So we have $14,080. We give the NCI their share, which is 10%, so we've got $1408 that's allocated to NCI. So now, these are calculations. So you might be thinking, well, what are the worksheet entries here? Because the only worksheet entry we've really done was to eliminate the pre-tax gain at its full amount and remove the income tax expense. What do the worksheet entries look like for this little guy here, the $60? Well, all we're doing here is we are removing or reducing, I should say, the depreciation expense for consolidation purposes by 100. And because we have an accumulated depreciation account, any adjustments to depreciation expense would be made directly to accumulated depreciation. And you'll notice in the separate entity statements, they give you an accumulated depreciation account. Where do I have the balance sheet? Right here. So if you look at the balance sheet, you'll notice we've got an accumulated depreciation account here, right? So the idea is, because we already have that account, we can use it. If they just said equipment at net and they didn't show you accumulated depreciation, then you just debit equipment at net. You debit that account. But because we had it, all we're going to do is reduce the consolidation account, accumulated depreciation, by 100 and reduce depreciation expense. Don't forget, when we reduce an expense, we increase pre-tax income. So when we increase income, we're going to have to book tax expense on it. Well, we're booking $40 in tax expense, which means of the $120 that we set up as a deferred tax asset or prepaid, now we're paying $40 of it from a consolidation perspective. So we're going to reverse out that deferred tax asset by $40. So now, if we looked at the financial statements for year one, what do we have? Well, notice when we removed the gain, right? So if you go back up here, I don't know if you've got your handout with you or not, but when you remove the gain, you reduce the equipment. We did that here on using the direct method. Remove the gain, reduce the equipment. Notice here we're also reducing our income tax expense because we removed the gain, and we're setting up our deferred tax asset at 120. All right, we're doing that. Now, when we recognized of this $300 gain, 100 of it, how did we do it? We reduced depreciation expense by 100. Remember what we just did? We reduced depreciation expense by 100. And when we did that, we reduced our accumulated depreciation, because it's just like any adjustments you make to inventory would affect cost of goods sold. Any adjustments you make to depreciation expense would affect accumulated depreciation or the equipment at net, whatever you have. Those are the accounts that kind of pair up between balance sheet and income statement, right? So same idea here. We adjust our accumulated depreciation downward, and when we do that, when we reduce our depreciation expense, we're also recognizing 40% of it as increased income tax expense and reducing our deferred tax. So that kind of sets us up using the direct method to get a balance sheet here from a consolidated perspective that balances. Notice we've taken our NCI calculation and just put it in here, right? So now we're good. So now let's have a look at what happens in year two. Well, now we've got the separate entity statements in year two, and all I'm doing here is repeating what we did in the intercompany profit analysis. And what we said before, I'm just repeating it here, we wound up with an unrealized balance. What we had left to take into to consolidated profit, 120. And in year two, because it's the last year of the useful life of the asset, we're taking it all into consolidated income, 120. Oops, just go back. Taking it all in at 120. So what happens at this point? Well, again, we have no more unrealized balance. That's what I've basically pulled out for you here. And we're going to adjust the sub's separate entity income for year two, which was $3,100, upwards by 120. Not literally. We don't go into the sub's separate entity books and do it. These are just calculations to facilitate the preparation of the consolidated statements. So the consolidated entity in the second year would show consolidated net income of $7,270, and we need to add that back into the sub's income, not literally, but just for the consolidation calculation to get it to $7,270. Now, notice here that calculating our opening balance of consolidated retained earnings, we had in that opening balance of consolidated retained earnings, in that $6,200, it included $120 of the gain that the sub had at net. Well, don't forget the at net gain that it reported on July 1st, year one, okay, was $300. Net of tax, that would have been $180. We recognized in year one $60 of it. So at the beginning of year two, there's $120 in the $1,700 that's still unrealized. In fact, you know from up here, that $120 is going to get realized in year two. right? Well, we're only at the beginning of year 2. So in this calculation, they backed it out to give you consolidated retained earnings at the beginning of the year once the parent takes its share of the adjusted post-acquisition retained earnings of the sub. It has consolidated retained earnings at January 1st of $14,822. Now, don't forget, what do we mean by adjusted post-acquisition retained earnings? Post-acquisition means after acquisition. $4,500 were the acquisition retained earnings. We're assuming that it was it was just data I didn't give you, but you're seeing it here now. So we have post-acquisition retained earnings of $1,700, and we adjust it by 120 because there's 120 in that $1,700 that can't be realized until year 2. So the adjusted increase since acquisition, I refer to that $1,580 as post-acquisition adjusted retained earnings, of which the parent takes its share. So consolidated retained earnings at January 1, year 2 is $14,822. Now, if you calculate NCI at the end of year 2, don't forget we don't have to make any adjustments to the sub's retained earnings. Why? Because by the time we get to the end of year 2, we see we have nothing unrealized. The consolidated entity has taken it all in, so there's no need to adjust any of the retained earnings of the sub because it includes that net gain of $180, and it's all been realized by the consolidated entity. So the consolidated entities, the consolidation books looked after by the parent's accountants, they would say we don't need to adjust them any further because we would have legitimately taken in that entire $180 net gain into consolidated income by the end of year 2. So retained earnings is right. So NCI, we don't have to adjust this $9,300. We're good. Now, the last part would be, how is this going to affect the year 2 consolidated statements? The way to see this so that you can see how we're building it up in the income statement, what each account is going to have as its balance, is to look at what the worksheet entries would be to recognize that $200 pre-tax gain. So, again, to recognize that $200 of $300, we'd reduce depreciation expense, offset to accumulated depreciation. When we reduce an expense, we increase pre-tax income, so we have to book on a consolidated perspective. We have to book tax expense on that. So the consolidated entity would say, well, now we're realizing $80 in tax expense coupled with the tax expense we realized back up here in year 1, right? If you go back up here, that means we reversed now our deferred tax account by 40 plus the 80 we just saw. So now our deferred tax asset has been totally used up. In other words, there's nothing more that's prepaid from the perspective of the consolidated entity. So now we have no more deferred tax balance left. So when we get into the statements here, okay, we get into the statements. I'll get to this guy in a bit. We notice that on the income statement, we would have reduced the depreciation expense to take in the pre-tax gain of $200, and we would have also where is that here? The accumulated depreciation. So now you'll see here in the accumulated depreciation, sorry for that pause, you'll see now we've got accumulated depreciation debited by 200 here, coupled with what we did back up here when we debited that same account by 100 in year 1 when we recognized the or booked 100 of the $300 gain. So in total, what do we have? In total, we have $300 here, right? Sorry for the scrolling, folks. We have this 200 plus the 100 we just saw. So that means your accumulated depreciation went down 300. All right. Now, if you look at the effect on your tax expense, Your tax expense now has gone up by $80 and your deferred tax asset has gone down by 80. Now notice that in the consolidated balance sheet they no longer show you the deferred tax asset. But if you go back to the end of year 1, you know it was sitting at 80 bucks, right? If you go back up here, it was sitting, the deferred tax asset at the end of year 1 was sitting at $80, right? Right here. But now you reverse that out. You no longer have a prepaid tax because by the time you get to the end of year 2, that total 120 has been fully realized. So now your asset or your prepaid's been used up by 80. So the 80 you had and the 80 that you're using up, you got nothing left. They just didn't show you the 80 minus 80 in here. They didn't show it to you because it's a zero balance account. All right. So now, the only thing that we didn't talk about here, this would kind of happen in subsequent years, like in year 3. You notice I had this and I kind of got rid of it because I realized it might have been confusing initially where I put it, is that in year we don't have it anymore, like we don't have it in year 3. All right. But the idea is, okay, that we are still going to be showing, if you consider that these that the consolidated books in these problems that we're doing are always starting with separate entity balances. In year 3, the accumulated depreciation would still be sitting on the parent's books at $1,800. So in subsequent years, for the period of time that the equipment stays within the consolidated entity and it's not sold, we'd still be showing equipment at $1,800 and accumulated depreciation of $1,800. So to make those figures right, because that's what the parent would be showing, we would have to keep reducing our accumulated depreciation by $300 and reducing the equipment by $300, and this would be in subsequent years. After year 2. All right. Now, different companies have different ways of handling their depreciation, you know, on assets that they may no longer be using. But I'm just making the assumption that if they had this asset still on their books at the end of year 3, if we're starting with separate entity statement amounts, the parents and the subs, you just have to remember that the parent's going to be showing equipment at $1,800 and accumulated depreciation at $1,800, but the true equipment would be still sitting there at $1,500, which was the original amount paid by the sub, and accumulated depreciation would be $1,500 because that's the true amount of the accumulated depreciation on that $1,500 asset. So you would have to be reducing accumulated depreciation from consolidation purposes from $1,800 to $1,500. So this would be made in subsequent years after year 2 if P still has that asset on its books. So this concludes our short video, probably not so short, but our video on the concept of handling intercompany profits on depreciable fixed asset sales. I hope you found it helpful.